There's a new low-cost producer in town who has posted strong numbers despite the second quarter only seeing 2 months of commercial scale production. Of course, we're talking about Artemis Gold, who saw their Blackwater project in British Columbia finally hit scale at the tail end of April. Despite being the street's newest gold producer, they've put up some numbers that would be impressive for a long-running operator. With that being said, let's dive in. Artemis Gold in the second quarter of 2025 posted top-line revenue of $231 million, which is a strong result for just 2 months of commercial production. Of course, there's no period worth comparing to here, so it might be a bit of a shorter video. In any case, that revenue figure follows the sale of 49,500 ounces of gold at an average price of $33.26 an ounce. However, Artemis is a little cagey about this number because it includes pre-commercial production ounces that were sold. And we're assuming it's because it messes up their per ounce cost metrics. Instead, the news release highlights gold sales of 34,000 ounces of gold, which is for the period of May 1st through to June 30th. Anyways, gross profit for the quarter totaled out at $168 million, with Artemis, after all expenses, posting an income before taxes of $147 million. Net income, meanwhile, totaled out at $100 million, or 43 cents per share. Analysts, meanwhile, had called for 25 cents per share, making this quarter a massive beat. EBITDA for the quarter came in at $169 million, which on an adjusted basis shrank to $146 million. From a cash flow perspective, Artemis saw net cash from operating activities of $185 million. No free cash flow figure was provided. Artemis ended the second quarter with $55 million in cash on hand, which was up from $28 million at the start of the year. The second quarter saw principal repayments of $27 million on their debt, while year-to-date repayments are said to be at $67 million, which includes a $40 million repayment in July. On the debt front, as of June 30th, Artemis has $398 million outstanding under a project loan and cost overrun facility, alongside $109 million outstanding under a standby facility, the latter of which was the subject of that July debt payment. On that total figure, about $222 million is current, which has led Artemis to source a $700 million revolving credit facility to refinance existing debt and provide flexibility for near-term expansion options. That facility remains subject to closing conditions. All right, let's move on to the production data, which seems to be what everyone is here for anyways. Artemis in the second quarter produced a total of 50,600 ounces versus analyst estimates of 42,000. Year-to-date, production has totaled 63,000 ounces of gold. But as we said earlier, metrics provided were really just for this post-commercial production period, which basically means the months of May and June because production was still ramping in April. Over this period, 34,800 ounces of gold was produced from 989,000 milled tons of ore, with average grades of 1.34 grams per ton gold and recoveries of 84%. The mill itself is said to have operated at 102% of nameplate capacity, while modifications were made in late July over a 3-day shutdown period to improve the dry and wet circuits for further capacity above nameplate. The changes are said to have also impacted gold recoveries, which were initially lower than planned, with further initiatives underway to improve these recovery rates. In terms of costing, cash costs for the commercial period came in at just $690 per ounce, while all-in sustaining costs were among the lowest in the industry at $805 per ounce. For reference, Agnico Eagle, whom is considered one of the lowest cost producers in the industry, saw Q2 all-in sustaining costs of $12.89 an ounce. Barrick comparatively had an AISC of $16.84 an ounce. Costing, however, was not provided on a per ounce basis for the entire quarter. Finally, the outlook. Artemis, as it stands, has not changed their guidance for 2025, with production guided to be between 190 and 230,000 ounces for the entire fiscal year. That guidance includes 160 to 200,000 ounces that are expected to be produced during the post-commercial production period at all-in sustaining costs between $670 and $770 an ounce. This, of course, means that Artemis is expecting production to ramp and costs to come down in the second half of the year. Based on the production rate in May and June of 17,400 ounces of gold, on average, the second half of this year is on pace for 104,000 ounces of production as it stands. Combined with the first half production of 63,000 ounces, and well, despite the strong results in Q2, Artemis might find themselves in a pickle if recoveries and throughput don't improve. All right, so let's wrap it up. The second quarter was no doubt outstanding for Artemis. When new mines come online, they're often hit with unexpected stumbles that are just a natural part of scaling. Just ask Equinox about their Greenstone mine if you want an example. But instead, Artemis has operated Blackwater impressively, even if recoveries are coming in a bit lower than initially expected. With that debt about to be refinanced at lower rates and throughput improving, this thing is set to be a cash cow over the coming quarters. Which leaves us asking one question really: what's next? Are they going to acquire a new development asset or hit the cash out button with a sale to a larger peer? All right, everybody, thanks for watching. If you want more earnings videos, check out our YouTube channel. We've got lots of them, and we got more coming up. If there's stories you want us to cover, as always, let us know in the comment section. And if you want more mining content, check out our website over at thedeepdive.ca. All right, everybody, thanks for watching.